This is Tax Chats. Hello, I'm Scott Dyring.
And I am Jeff Hoops.
And we're here to chat
about taxes.
Hello again, and welcome to another edition of Tax Chats. I'm Scott Dyring, professor of accounting at Duke University, and I am joined by my rival at the University of North Carolina, Jeff Hoops. Hello, Jeff.
Yes, rival and enemy.
Rival
Bitter
and enemy.
Enemy.
Especially pertinent this week because in the Final Four, Saturday night, Duke and UNC will face off for the first time in history in the NCAA tournament. And of course, as we all know, Duke will win.
If the last game Duke and UNC played as an indicator who was going to win, I wouldn't be so confident there, Scott. So we'll
but
see
if
how
the
it goes.
First game they played this year is an indicator of who's going to win, then I can
think
retain
if you
my
average
confidence.
the two scores, I think
Duke would win.
I'm not sure. I don't even know. I think we win.
It was pretty much a blowout in the first game.
If you
favor of Duke.
if you do the time-weighted average of the scores over the entire... Anyways, UNC is going to win. That's fine. Okay,
All
so...
right, we shall see. Well, we're totally off track because we have, I think, a very interesting guest. Jeff, tell us about our guest.
So we are going to be talking about a little bit of the unbasics of crypto taxation.
What is an unbasic?
Well, so how this works is whenever, like in class, or somebody talks to me or asks me about like taxes and cryptocurrency, I will say something along the lines of, you could think about cryptocurrency as a capital asset, and then I'll just tell them about like stocks and taxes. And for a lot of cases, that's true. I mean, the IRS kind of considers cryptocurrency a capital asset. You can think about it as a stock in most cases, but there's some big differences, some things that like cryptocurrency has that stocks don't have that I kind of understand. I know what are, but I don't ever explain because I don't understand the deepness of it. And so we found somebody who does. So here with us is Tyler Menzer. So welcome, Tyler. Can you introduce yourself?
Yeah, I'm Tyler Menzer. I'm currently a PhD student at the University of Iowa, studying cryptocurrency and taxes, currently with the IRS. And I worked in practice in public accounting for about 5 years, where I actually worked on some cryptocurrency returns and kind of helping our firm figure out how we were dealing with cryptocurrency, which was a while ago when stuff was a little bit more basic. It's only gotten more complicated since then, but hopefully I can first confuse and then solve that confusion a little bit for you, Jeff. So
yeah, I mean, it's if you think about like crypto and taxes, you were there when it all began almost. It's as if we were interviewing somebody about the income tax return and they were born in like 1900 and they were 13 preparing tax returns when it all began sometime
which is kind of amazing because it's only been 5 or 6 years, 7 years, something like
2014 since the IRS clarified.
I remember looking at the 2014 regs when that was basically the only formal guidance on cryptocurrency. And you just had to assume whatever you assumed from the question and answers in that notice and hope you were right.
Yeah, why don't we start out just telling us exactly what happened in 2014, which is kind of a basic thing, but then we'll get a little bit more complicated from there. Tyler.
Yeah, so kind of cryptocurrency has been around since like 2009, 2008. It was kind of a creation out of the financial crisis. It wasn't until 2014 that it really, I think, got big enough for the IRS to care. And so they finally, there were enough people asking questions, enough people invested in this, enough people concerned about it, that the IRS put out this notice that basically was just kind of like questions and answers. How is cryptocurrency treated? This is where we find out that it's treated as property, not as currency, which there was a lot of debate about at the time.
I mean, it does have currency literally in its name.
In its name, but it is not currency for IRS tax reporting purposes.
And it's too bad because crypto property just has quite a nice ring to it. Much better than cryptocurrency.
Well, I think
I mean, obviously I'm being facetious, but yeah.
The crypto property are now called non-fungible tokens, which is a little bit more akin to property, but we can get into that maybe a little bit. But basically, I mean, the notice was really just kind of like, here's commonly asked questions, here's what the IRS thinks about it, Still left a lot of stuff open, but at least it gave a little bit of guidance to those of us who had clients that were trying to deal with this stuff. Cryptocurrency was still in its infancy. Like there weren't as many tokens as there are now. There weren't as much, people weren't doing as much with it. And since then, it's really evolved. Jeff, you mentioned it's kind of like stocks. And, for Bitcoin, which is the largest, Ethereum, which is another major cryptocurrency, that's pretty true. It's kind of like a stock. But the way that I think about it now almost is if you can think of any financial asset that has been developed over the last 100 years, right? Some cryptocurrency developer has coded it up and put it on the blockchain, and it's entirely unregulated outside the financial system. So you can do derivatives, you can do loans, you can do everything with cryptocurrency. And so, as you can imagine, a bunch of people who are computer programmers, programming complex financial transactions completely outside of regulation, ends up raising a few questions and ends up with a few weird things going on. And so that's kind of where we are now.
So can we just start? I want to back up just a little bit for the sake of myself and for others who are listening, which is explain to us the significance of the fact that the IRS decided to treat crypto as property as opposed to a currency.
Yeah, so I think, there's a lot more that is speculated about this than maybe is warranted. So in general, like if you think about it, Scott, you go over to Europe, you change your dollars into euros, you buy a croissant in France, and you don't think about reporting that for tax purposes, right? Because it's currency. You traded one currency for another.
Unfortunately, we lost Tyler for about 5 seconds and pick him up as he comes back online.
I'm going to worry about that on your taxes. So that's how most people think about currencies. And so if it was treated as a currency, you do get some exemption from the tax rules for personal transactions that are really small. And so that's what people were kind of hoping for. Property, you don't have any of those exemptions. If you trade property for something, it's going to be taxable.
Doesn't matter how small.
Doesn't matter how small. You don't get those small exemptions. Now, I think that the consequences are a little bit understated because most people are still using cryptocurrency as an investment, right? You have these enormous gains that you hear about in the news. And so those are going to be taxable either way, whether it's currency or property. The other thing that, a lot of people have speculated is that there are specific tax rules called like-kind exchanges. And this is when you take one type of property, which we say cryptocurrency is property, and you exchange it for a different type of property. And typically, the most common way of seeing this before the new tax law in 2017 was with cars, right? You had a company car, Scott, you were driving your Maserati that Duke pays for. Duke trades it in for a newer model, and they don't have to pay tax on that gain if there was any gain on that trade-in. And so there's some talk that, prior to 2017, the IRS changed the rules at that point. Prior to then, because cryptocurrency was taxed as property, could you actually use it as kind of a like-kind exchange and defer gain? So if you traded Bitcoin for Ethereum, which is a different type of cryptocurrency, but they're both cryptocurrencies, you're trading one property for another, could you defer the gain on there? So I think those are kind of the two biggest things relating to the property.
And to be clear, with stock, you can't do that. I can't trade Walmart for Target and get tax-free. Explicitly, just don't. You have to pay.
Yep, it is only property. So that property classification in the like-kind exchange is really important.
Yeah. So a few more places where I think it'd be interesting to talk about the differences between cryptocurrency and just like stock is with stock, I can't just like sell stock at a loss and buy it back the next day. Can you explain this, how the wash sale rule applies currently to cryptocurrency and to stock?
Yeah, so the wash sale rules are something that probably a lot of people don't realize, and maybe come tax time end up owing a little bit more than they thought they were going to. It's basically meant to prevent the tax harvesting of losses. So, I buy a stock at $100 in December, it's down to $30, and I say, oh, well, I want to sell it, but I think it's going to go back up. So I sell it, I have a loss of $70, and then I just buy it back at $30 again. And for a stock, what the IRS says, well, if you buy it back within a certain period of time, you're not really selling it, right? Because you still own it. And so you don't get to deduct that loss on your taxes right away. For cryptocurrency, those rules currently do not apply to cryptocurrency because they're not considered, in the security realm and under the IRS code. And so, I will tell you, in last December, a couple months ago, I had some losses on some cryptocurrency. I sold it in December and I bought it back, basically the next minute. Um, I'm going to take those losses on my tax return because there's no rule kind of preventing that. And so it's a way to, if you're losing, but you still want to keep the stock, keep the cryptocurrency in this case, because I think it's going to go back up. I can sell it. I can get that tax benefit right away without giving up my actual ownership and kind of risk in that asset and potential return in the future.
Okay, so those are some like big issues that I think maybe if people have spent a little time Googling around, they maybe have heard of. Like the wash sale rules, there was an article in like some of the major newspapers, around the end of the year when these kinds of things kind of come up. There's all kinds of other strange things about cryptocurrencies that I don't even understand what they are, let alone what the tax implications. And I know that you know many of them. So maybe tell us your favorite quirky thing about crypto and what tax implications might go along with it.
Yeah, so I'll tell you my favorite thing. I unfortunately don't have a definitive answer on the tax consequences, right? Because this is why we need the regulation. This is why these things are coming out. But you guys may have seen in the news a couple months ago at this point, it was called the Constitution DAO. So a DAO is a decentralized autonomous organization, which is kind of a fancy term for basically saying a bunch of people contribute money and then they vote on what happens with that money. And it's all decentralized, so there's no like single person controlling it. And the purpose of this was a copy of the U.S. Constitution was put up for auction, and somebody online said, "Hey, we should buy this as a community of cryptocurrency users, and then we'll figure out what to do with it. Everyone will get a vote on what to do with it." And so they were collecting money, and you could send money to this organization through the blockchain with cryptocurrency. They ended up raising like 140 some $1 million from just cryptocurrency users who were willing to invest in this asset to buy the Constitution. And then the it comes up for sale. There's an auction, and they lose the auction, right? Which, whole different thing. But the guy, one of the hedge fund managers who was a big deal in the GameStop fiasco in January, was actually the winner. And so now this organization that has $140 million doesn't have, the ability to buy the Constitution anymore. They lost the auction. And what happens with that money? And the really interesting thing here is that in some cases, the transaction fees on cryptocurrency are really high. And so you had people who were, if you just wanted to send $100 to this organization, you say, hey, I don't really, I'm not a big guy, but I'll just send a little bit to be a part of the thing. Well, in some cases, the fees that you paid sending it in and the fees that you would have to pay to get your money back out would basically eliminate your entire investment. So there's actually evidence on the blockchain that people paid money to basically withdraw their money and not get anything, right? So they were trying to withdraw $50. They ended up paying $2 and getting nothing because the fees were so high. And so there's an interesting question of how does this get treated for IRS tax purposes? When I sent money in, and I received kind of this token that said, hey, I'd sent money into this organization, is that a taxable transaction? Typically, you would think, well, I'm exchanging one type of property, I'm getting another type of property, a token, so that is a taxable transaction, generally for IRS.
But you're just buying a token. You wouldn't pay it if you're just buying a Bitcoin. So why would it be taxable if all you're doing is just buying a special kind of token just because they were going to use all the proceeds from the purchase of that token to buy the Constitution?
Because the only way you could buy the token was with cryptocurrency. So they had to sent Ethereum to this contract.
Yeah. So then it comes to the like-kind exchange thing. So if you get a like-kind exchange, then no. But if not, then
Right. And so, I mean, typically I'd say taxable, but then they lose the auction, and now, the purpose of this is gone. The tokens that were supposed to be kind of the voting rights to this are gone, and you have people withdrawing that money. And so, did they really ever get anything for their sale? Was it, an investment? What's their basis? How do you deal with all these fees? Because you have the fees going in, you have the fees coming out.
It's like if it were a marriage, you wish you could just like annul it.
Exactly.
But there's no annulments in the tax code. It's a fascinating example.
And so there's these questions of what happens with the fees. I mean, the fees are really a big thing in cryptocurrency, because typically when you're selling a stock, right, you're only incurring fees, and it's way less now than it maybe was 10 years ago, but you're really only incurring a fee when you're actually trading. So you get to deduct those fees against your taxable gain.
And it could be like 2 cents these days.
2 cents, right? I remember when it used to be like $7 and you really had to decide, do you want to buy the stock or not?
Yeah.
But with cryptocurrency, I mean, some of those fees can get to $30 or $40 regardless, because it's a flat fee to record the transaction on the blockchain. And let's say you just want to take your money from, a cryptocurrency exchange where you bought the cryptocurrency, and then you transfer it to your own personal cryptocurrency wallet. Well, that's not a sale exchange, but you're still paying fees in regard to that. So what happens with those fees? Are they investment? If you transferred it to your own wallet with the intent to sell it right away on a different cryptocurrency exchange, are the fees then deductible? How do you determine which fees are sale related and which fees are just transfer related? That would just be investment expenses, which are generally not deductible for people. So there's a whole bunch of issues that come up that we just don't know about.
Seems like there's a lot of questions. So one thing that I heard about recently, there's a case about staking and the taxability of staking. Can you just tell us like what staking is and what we know so far about the taxability of this? And my understanding is it's still an issue that like it's a little bit up in the air.
Yes. So Jarrett v. United States, super interesting case actually. So staking in general. So in cryptocurrency, you have to have some way to record transactions to the blockchain. How Bitcoin does this is it says we're going to reward people for recording these transactions, but we're going to limit it, and we're going to say whoever has kind of the most computing power has the most likelihood of recording these transactions and reaping these fees. And so that's where you get into the articles about the environmental impacts of cryptocurrency, because it's basically you have power plants that are bought purely to mine Bitcoin, because it uses so much energy to do these complex transactions. You need so much computing power. Staking is kind of a different method that has been used in some cryptocurrencies to kind of get around that. Say, we don't really care about doing these meaningless transactions. We're just going to have people stake
There's computations.
There's computations. And so what staking says is, I have 1,000 cryptocurrency coins, and I'm going to basically agree not to be able to use them for a certain amount of time. And I'm going to commit to having them, not being able to use them. And then that determines whether I get to write transactions to the blockchain. And so, if I commit a lot of coins, I have a good chance of writing the transactions. If I write the transactions, I get the fees and benefits associated with that.
Which is like
and then eventually more coins.
Yeah.
And then eventually I get my coins back.
So many coins.
And so this Jarrett case, what happened is this guy kind of, I think, had this plan all along. And he engages in some cryptocurrency staking. I think he makes like $9,000. And he reports it on his taxes. And he says, this is taxable income, IRS. Here's my return. here's the tax I owe on this staking income. Then he immediately, after they, process his return, he goes and files an amended return. And he says, no, 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 IRS. Actually, this staking income is not income. I'm going to file an amended return. I'm taking that $9,000 of income off my return, and I want a refund. And the IRS says, well, no way. You reported it as income. We're not going to give you the refund for this money. So they're kind of saying, well, it is income. Well, then Jarrett said, well, then I'm going to sue you. So he goes and he sues for the refund on this income, under the pretense that it is not actually income. Well, then the IRS says, oh, hey, wait a second. Right, we'll just give you the refund. Right? They're trying to make it go away. I think my opinion on this is purely my opinion, is that, right, they didn't really feel comfortable. If you go through with a court case, that kind of creates a precedent. And so the IRS doesn't quite feel comfortable like creating a precedent without, thinking about it really in depth. And so they just tried to say, hey, we'll give you the refund. Well,
and was this person trying to like force the issue? Is that what's happening here?
It doesn't just end with him accepting the payment. He says he wants some definitive statement.
No, he in fact rejects the IRS offer and is taking it to court. So it's currently going to court. There will be a ruling at some point that determines whether this is income or not. And the idea kind of behind it not being income that they're arguing is that in mining, so with Bitcoin, you have to like do calculations. You have to do computation. So there's work. So while you're getting a benefit for work, that's income. But staking, you're not doing anything. It's passive.
It seems like you're loaning money, and it would be like interest income to me, or no?
It seems like that. That's how I kind of think about it. I would not file a tax return saying that it's not income. But so that's the theory is that it's not actually work, and so you're not being paid for work, and therefore it's not taxable. It's just reduce it. Your overall basis stays the same, but you have more coins. So we will have to wait and see at how that court case comes out. But it's certainly, kind of trying to force the IRS to create regulations through court cases, or force judges to create regulations.
Okay, so that's really interesting, actually. And it sounds like probably many of the things that we might talk about, the answer could end up being, we don't really know yet, but we're going to figure it out.
There are several that we do know, actually. The IRS says, so since 2014, they've come out with a few more statements. It's like, here's how we tax X. We could talk some more about those things. There are some definitive answers on some things.
Okay, but before we go there, and I want to get your opinion on something else, which is, if you're just like a typical person who's following the news, you probably have heard a lot of talk about cryptocurrency, in part because many people believe that it is used as a mechanism to engage in criminal behavior. And those behaviors could be all kinds of things, transactions on the dark web, whatever, and possibly even tax evasion. Is there any truth to that? And if so, why? Or if not, why not?
So I think it's complicated. So certainly at the kind of beginning of cryptocurrency, there was probably a very large percent was kind of illegal. A lot of it wasn't reported, even if it was legal transactions. Now there's a company that kind of analyzes the blockchain and kind of classifies where money is going, where cryptocurrency is kind of being sent to and sent from. And so every year they kind of come out with a cryptocurrency crime report. And they break it down and say, hey, this percentage, this much of cryptocurrency was going to illegal gambling sites, or this was going to dark web marketplaces, things like that.
And can they figure that out because of the ledgers that are associated with blockchain technology?
Yes. So Bitcoin, we always call it pseudo-anonymous. So it is anonymous in the sense that I don't know which wallet is yours, Scott, but I do know there's a specific number for a wallet, and I can tell the transactions going in and out of it.
They placed a lot of illegal bets saying that UNC basketball will win, because that's what Scott really believes.
Yeah. Well, so this is kind of interesting because if I use just good old
Yeah,
cash,
that's
like
what I was gonna
greenbacks.
say. Is cash is like used for illegal stuff all the time. I like this like criticism of cryptocurrency. Oh, people are going to use it for illegal things. The U.S. Treasury literally prints the most illegally used asset ever, which is just like cash.
Well, and cash is interesting because if I want to figure out how much cash has been used in a drug deal, I mean, maybe I get a like a drug bust once in a while with a suitcase full of cash associated with it or something. But like, I seem to remember at a conference, maybe you were there, Jeff. Somebody came through and they were talking about certain aspect of cash, and somebody had run like tests to see if there was like drug residue on dollar bills, and like a very high percentage of dollar bills had like cocaine residue on them or something crazy like
Yeah,
that.
so I remember the
And
conference, and it was a very unreliable statistic. But yeah,
it was
that's
unreliable, but it was very fascinating. And the reason that to me it's relevant here is how do you figure out if a dollar bill is being used in an illegal transaction? It's really hard. You test it for the presence of drug residue, which is super unreliable. And with blockchain, you can actually just figure it out directly because there's this ledger that's associated with every single transaction, which I think is kind of fascinating. Okay, so let's say there's illegal behavior or whatever. I mean, it's kind of traceable, but is it particularly useful for tax evasion or not really?
So, I mean, I think the ideal version of tax evasion, I think, is being able to invest in what you want. Um, and so, while cryptocurrency definitely does support, if you don't want to report cryptocurrency, it's really hard for any government to figure out your individual wallets without already kind of having some idea that they want to look at you.
if you're on you have to do it in a specific way. You have to be like on the blockchain, etc.
Yeah, and so the IRS has definitely tried to go after exchanges. There was a big Coinbase lawsuit. They currently have kind of lawsuits against two other large major exchanges to get customer data to find out whether people are reporting these. But I think the biggest difficulty in just tax evasion, it's like yes, if you want to invest in cryptocurrency, you can do that, but it's a super risky asset. So you have to already want to invest in cryptocurrency, want to invest and hold and trade this risky asset without, in the first place, in order to use it for tax evasion. Now you can like kind of transfer money overseas and stuff a little bit easier. So it certainly has some of those properties. I think the current statistics that I've seen, and I don't have numbers, but cash used for illegal activities just dwarfs cryptocurrency because it's so much more prevalent. That being said, like in some years, you're talking about hundreds of millions of dollars used for illegal activity in cryptocurrency, so it's not peanuts either. So
And it
you
does
can have arguments on both sides.
and it does facilitate a different type of illegal transaction or illegal activity, right? So with cryptocurrency, you don't have to see the person, whereas cash, you have to physically exchange an actual piece of paper.
Well, and one interesting thing that has come out just recently is there's some rumors that Russia, who is under sanctions currently for the invasion of Ukraine, may begin accepting Bitcoin as payment for oil. And so it is potentially a way, which is super interesting because like 3 months ago, the Russian central bank was very anti cryptocurrency. This whole sanction regime has kind of switched that around. And now they're potentially going to start accepting Bitcoin as payment for oil. And so you could say, well, that's a way to get around sanctions. It's a way for, people to avoid the international monetary system and still buy Russian oil. So in a way, that could be another illegal use case that's very different because you're not going to probably have hundreds of $1 millions of cash sitting around. That gets a little bit unwieldy. So
And so outside of the kind of current Russia-Ukraine conflict, obviously, other countries have been thinking about crypto for, a long time. What are they doing with crypto? I mean, the US is treating it as property. Russia's didn't want it. Now maybe they do. Like, are other countries is everybody treating it similarly? Are they doing it differently? Like, what's happening?
it is a roll of the dice and see what you get. So there is a patchwork of everything. China, there is some big news. They banned cryptocurrency. There's actually some evidence that people are still using it and mining
Except for their
cryptocurrency.
own.
except for their own. So they have a central bank digital currency, which is a slightly different thing, but similar idea.
But hang on, you said that despite it's being banned, there are still people in China who are probably using it like on the black market or mining it or whatever.
Yeah, so there's some evidence in a recent paper. I don't know the site off the top of my head, but they basically look at like energy consumption, and we know how much energy is kind of being put into the Bitcoin ecosystem because we can see how much computing power is being used in the network. And so what they do is they look at blackouts in China, and they see when there's a blackout in these regions where there was previously high Bitcoin mining, they see the computing power on the blockchain go down. And then when power is restored, it goes back up. So there's, evidence that people are still mining cryptocurrency in China, against the kind of ban on it. India also, I believe, has banned cryptocurrency. Then you have countries like Portugal, where, for personal transactions, there's basically no taxes on cryptocurrency. They treat it as a currency. And then you have El Salvador, which kind of accepted Bitcoin as a official currency and has like sold Bitcoin-backed bonds and stuff like that. So, there's kind of a huge gamut of everything that you could think about. There's very, very friendly countries and very, very adversarial countries.
Which are all reflected in their tax rates. Yeah.
Yes. I know. So the Biden's recent budget, a little bit, have some proposals in there for some information sharing between countries to try to get at some of these differences and see what people are reporting in other countries, similar to what we have for certain cash transactions and stuff. The European Union is kind of coming out with new rules. And so I think there's a push to begin to kind of standardize and think about these things on a more global scale, because at the end of the day, like Jeff said before, I can send money to somebody in China sitting here in my living room, and I don't need to go. You're right, it's global. It's not bound by countries. And so, the need for a broader worldwide regulation just becomes more and more important.
If you believe on limiting transactions between you and a Chinese person, which you may not.
That is true.
Yeah. Jeff, we have time for one more question.
Okay, so one more thing.
Make it good.
Okay. I want to know what an airdrop is and how it's taxed.
An airdrop. So cryptocurrency is pretty interesting. And so the founder of Ethereum, which is one of the largest blockchains currently around right now, right? He's kind of a celebrity in the space, right? He's like the Steve Jobs or the Bill Gates. He's one of the big guys.
The Scott Dyring of
the accounting world, right? So everybody knows his name. Everybody knows who he is. And so you have people coming up with new cryptocurrencies, right? The Jeff Hoops coin, Jeff wants it to be really big. He wants to get, some insight and get some excitement built around it. And so one of the things that people will do, and there's different ways that this can happen, but they'll just send out their cryptocurrency to certain wallets. Now, sometimes that's, hey, you already had this coin, we're sending you some more, or we're sending you a related cryptocurrency coin. Sometimes
so if I know if I just have a random Bitcoin wallet ID, I can send an Ethereum or a Hoops coin to that same wallet?
Subject to some limitations, but yes.
Okay.
So they're doing this to generate buzz. So this would be like if the government wanted to make dollars more popular, they would just like print some and randomly send them to people.
Right. Exactly.
It's like sending out coupons for Big Macs.
It's better than that. It's like sending the actual Big Mac.
Sending the Big Macs in the mail, yeah. Or like the AOL CDs back in like 1999.
Yeah, you just get the AOL CD. Only there's no catch to it. You just get it.
Yeah.
Yep. So you can do this, and so what happens is, the Ethereum co-founder just ends up getting a bunch of random cryptocurrency coins sent to him because they're thinking, the Ethereum co-founder also owns some of this, even though he, and the other thing about cryptocurrency,
Oh, so,
It
sorry,
doesn't
they're
require
sending
both
it.
people to agree.
They're sending it specifically to this guy, so then they can claim. So it's like, yeah. So it's like I would send the thing to Scott and say, even Scott Dyring owns Hoops
He's a
coin.
He's a crypto influencer.
Yep.
Yeah.
So everybody wants him to have it.
And it, like, the interesting thing about cryptocurrency, it only requires one person. If I want to send money to you, Scott, you don't get a say in it. I can just send it, right? And so that creates like this weird taxation issue, because if I can send you something, can I then force you to recognize the tax on that gain, right? You're getting something of value. If I pay you $100 in cash, you can always just say, no, I don't want it, right?
So if I mailed Scott a check, or if I mailed him cash, he would have that cash. I guess the difference is this is cash. There's no tax. If I just mailed him some asset, you're just saying he could just say like return to sender and send it back. And there's no way to you can't just like send the airdropped money back.
Can't refuse delivery of the airdrop.
Close your wallet up.
No, you don't. It's going to go into your wallet. Now, you could send it back later, right? But then you're just sending cryptocurrency, and is that deductible, right? You already had it.
You can't instantly send it back, and so its basis and the proceeds would be identical, and so there'd be no taxes due.
Maybe. Is it tax deductible if you just give something away? Because you're not selling it, you're just giving it back because you're right. You're not exchanging it for anything of value. So is it a sale?
I'm gonna go get a Bitcoin wallet. I don't have one. I'm gonna get one.
Get the leather kind. That's what you should get.
Do you have a Bitcoin wallet, Jeff?
No, I don't own any Bitcoin.
Could you get it doesn't have to be Bitcoin. Just get a crypto wallet. Are the wallets currency specific?
Some are kind of, there's multiple currencies that'll go in.
Okay, Jeff's gonna get a generic wallet, and I'm gonna get a generic wallet, and I'm gonna send Jeff like one. I can't use a Bitcoin though, because one Bitcoin would be like basically my life savings. I got to find something that's worth like $1 a Bitcoin. I'm gonna send it to Jeff, and I'm not gonna allow him to refuse the delivery. I'm gonna do this in celebration of Duke's victory over UNC this weekend.
Do you remember when this happened with Venmo, Scott? When we first discovered that, do you remember this? That Venmo transactions are public. I sent you several $1 deposits, and the label was like, for drugs and guns.
Yeah, because I was trying to incriminate me.
I wanted to be that on the public record that Scott Dyring was receiving money for drugs and guns.
Yeah. Well, Tyler, this has just been like so fascinating.
There is actually IRS guidance on how this is taxed.
What's the tax answer?
So the answer is, if you actually control the wallet and you have access to it, and you get the Bitcoin or the cryptocurrency, it is taxable. But there are some cases. So for instance, if you're on an exchange and it's being sent to kind of like everybody that owns a certain type of cryptocurrency, you might not have access to the wallet. And so if you don't have access to the wallet where the airdrop goes, you don't have to pay taxes on it until you get access to it. So the IRS kind of gave you a little bit of leeway where you only pay taxes if you actually control the cryptocurrency that you're getting airdropped.
Wow. I mean, and the amazing thing about this is we've just spent 30 minutes talking through these issues, and we covered about 25% of things that were on the list of things we could have possibly talked about. Well, Tyler, thank you so much for joining us, and clearly there's more to talk about, so I can definitely envision a future episode where we try to hammer out the remaining issues. And as the government moves on this and we get more and more information, I think there will be many fascinating crypto tax issues that will arise. So this has been another edition of Tax Chats. I'm Scott Dyring. Thank you for joining us. We hope you'll join us next time. Goodbye.
Goodbye.